Before we begin, please remember that I am not a financial advisor, and this presentation is for educational and entertainment purposes only. The information provided in this video does not constitute financial, legal, or investment advice. You should always consult with a licensed and qualified professional before making any decisions regarding your personal finances. Your financial situation is unique, and any action you take based on the content of this video is at your own risk. Dave Ramsey's mortgage advice is wrong. Not just a little bit wrong, but potentially catastrophically wrong for a huge number of Americans in today's economy. It's a statement that feels like financial heresy, I know. For decades, Dave Ramsey has been the undisputed king of personal finance for Main Street America. His voice has boomed from our radios, his books have lined our shelves, and his baby steps have guided millions of people out of the suffocating grip of debt. He's a titan. He's an institution. And I'm telling you, his single most famous piece of financial advice, the cornerstone of his wealth-building philosophy, could be the biggest financial mistake you ever make. And I know why you're here. You're probably up at 11 o'clock at night, the kids are finally asleep, and you're scrolling on your phone. You're flicking through Zillow, Redfin, Realtor.com, looking at these houses you can't afford. You see the list price and you wince. Then you look at the estimated monthly payment with today's mortgage rates, and you feel that pit in your stomach. Feels impossible. It feels like the American dream of homeownership is slipping through your fingers, reserved for a class of people you'll never be a part of. You're trying to do the right thing. You've heard the advice. You've listened to the call-in shows where Dave yells, "Sell the car." And you're acting like a child. You want to be responsible. You want to build a future for your family. But the advice you're hearing feels like it was written for a different planet for a different time. A 15-year mortgage? On a $400,000 starter home? With a payment that's 25% of your take-home pay? Who can actually do that? Does that person even exist anymore? That's the exact question we are going to answer. This isn't a hit piece. This is a deep analytical dive into the numbers, the psychology, and the modern context of Dave Ramsey's mortgage advice. By the time you finish watching this, you will understand the hidden dangers and the surprising opportunities that lie within his strategy. You will have a crystal clear, data-driven framework to decide what kind of mortgage is right for your specific situation, not the situation of a caller from 1998. We are going to arm you with the knowledge to walk into a lender's office with unshakable confidence, knowing exactly what you need to do to buy a home, and more importantly, to use that home as a tool to build real generational wealth. First, to understand why his advice might be wrong today, we have to understand why it was so right for so long. We have to give the man his due. Dave Ramsey has, without a doubt, helped more people get out of credit card debt and stop living paycheck to paycheck than arguably anyone else on the planet. His message is simple, powerful, and it works for its intended purpose: behavior modification. He's not really a math guy, he's a behavior guy. He understands that for most people, personal finance isn't about spreadsheets. It's about emotion. It's about fear and greed and keeping up with the Joneses. His core philosophy is that debt is the enemy. It is a monster that will eat your future. It's not a tool. It's not leverage. It is a moral and financial cancer that must be eradicated with what he calls gazelle intensity. And from this worldview, his mortgage advice is born. It is perfectly consistent with his philosophy. His rules are famously rigid. Rule number 1. If you're getting a mortgage, it must be a 15-year, fixed-rate loan. He despises the 30-year mortgage, calling it normal, which in his world is a 4-letter word. Normal is broke. Rule number 2. Your total monthly payment, that's principal, interest, taxes, and insurance, cannot exceed 25% of your monthly take-home pay. Not your gross pay, your net pay. The actual dollars that hit your bank account. Rule number 3. You must have a down payment of at least 10%, but preferably 20% to avoid private mortgage insurance, or PMI, which he correctly identifies as a useless waste of money. On the surface, this sounds incredibly responsible. It sounds like the boomer wisdom our grandparents gave us. Don't be in debt a day longer than you have to. Pay that house off, son, and you'll be free. And for an entire generation, this wasn't just good advice. It was a lifeline. To understand Dave, you have to understand his story. In the 1980s, Dave was a young, hotshot real estate investor. By age 26, he had a net worth of over $1 million. He was flying high. But he had built his empire on a house of cards, short-term debt. When the banks called his notes, his entire world collapsed. He went bankrupt. He lost everything. He talks about the strain it put on his marriage, the fear, the shame. It was a deeply traumatic experience that forged his entire financial philosophy in fire. When he tells you to hate debt, he's not just giving you a catchy slogan. He's reliving the worst moment of his life. He sees the 30-year mortgage, the car loan, the credit card, and he sees the same gun that was pointed at his own head. His advice is a shield. It's a fortress designed to protect you from the catastrophic failure that he personally experienced. Pay off the house in 15 years, keep the payment painfully low, and you will never ever be in a position where the bank can ruin you. From a purely psychological and risk-averse standpoint, it's brilliant. It creates a feeling of absolute safety. And back when he started his show, the math worked. In the 90s and early 2000s, you could buy a decent home in many parts of America for $150,000. Interest rates were higher, sure, maybe 6 or 7%. But the numbers were manageable. A 15-year mortgage on that house was achievable for a middle-class family. The 25% rule was a reasonable guardrail. His advice was perfectly tailored to the economic reality of that time. But here is the critical question we have to ask. Is a financial strategy forged in the trauma of the 1980s and perfected for the 1990s the right strategy for the 2020s? The world has fundamentally changed. The average price of a home in the United States is no longer $150,000. It's over $400,000. Wages have not kept pace. That's not a political statement. It's a mathematical fact. So the entire foundation upon which the 25% rule was built has cracked. For millions of Americans, especially in major metropolitan areas, following the 25% rule on a 15-year note means you can't buy a house. Period. You are permanently locked out of the single greatest wealth-building tool available to the middle class. So what does that do? It creates a system where people who follow his advice to the letter either have to be very high-income earners, or they have to wait. They wait and save for years, maybe a decade, trying to amass a huge down payment to shrink their loan amount enough to fit into Dave's tiny box. And all the while they're saving, what's happening? Home prices are going up. They are on a treadmill, running as fast as they can, but the finish line is moving away from them even faster. They are losing ground while trying to do the responsible thing. And then there's the other side of the coin, the part Dave almost never talks about: opportunity cost. By forcing every available dollar into your home equity, an illiquid asset with a historically mediocre rate of return, what are you giving up? When mortgage rates were at 3% as they were just a few years ago, does it really make sense to aggressively pay down a 3% loan when you could be investing that same money in an S&P 500 index fund that has historically returned an average of 10% per year? This isn't about being cute with debt, as Dave would say. This is about basic math. It's about understanding that in a low-interest rate environment, cheap, long-term debt can be a powerful tool, not an enemy. It's leverage. It's what allows you to control a large, appreciating asset with a relatively small amount of your own money, while freeing up your cash flow to invest for a much, much higher return elsewhere. His one-size-fits-all, fear-based approach completely ignores this nuance. It treats a 3% mortgage the exact same way it treats a 28% credit card. It's all just debt, and debt is bad. But this black and white thinking is a disservice in a world that is filled with financial gray. So we're at a crossroads. We have the advice from the undisputed master of getting out of debt, advice that promises safety and security. And then we have the cold, hard math of the modern economy, which seems to tell a very different story. A story of missed opportunity and a widening gap between the financially savvy and those just trying to stay safe. In the next part, we are going to put this to the test. We're not going to deal in feelings or philosophies. We're going to open up a spreadsheet and run the real-world numbers. We'll take a typical American family, a typical American home price, and today's actual mortgage rates. We will pit the Dave Ramsey 15-year mortgage directly against the 30-year mortgage that he so famously hates. And we're going to calculate the difference, not just in the monthly payment but the total long-term impact on their net worth. The results are going to shock you. It is the difference between simply owning a home and turning that home into a launchpad for true financial freedom. So let's meet our two families standing at the base of that launchpad. On the surface, they are identical, mirror images of the American dream. First, we have Sarah and Tom. And second, we have Mike and Jessica. Both couples are in their early 30s. Both have worked hard, saved diligently, and have 2 young children. They both have a combined gross household income of exactly $120,000 a year. After taxes, health insurance, and 401k contributions, They each bring home $7,500 a month. Clean, simple, and identical. They even have the same amount saved up for a down payment, $45,000. They live in the same city, they're looking in the same neighborhoods, and they are both incredibly excited and frankly a little terrified to buy their first home. This is where their paths diverge based on one single decision: whose advice to follow. Sarah and Tom are avid listeners of Dave Ramsey. They've done the baby steps, they've cut up their credit cards, and they believe in the gospel of debt freedom. So when it comes to the biggest debt of their lives, they adhere to his mortgage rules like scripture. And those rules are famously almost brutally simple and restrictive. Rule number 1. You only get a 15-year fixed-rate mortgage, not 20, and absolutely under no circumstances a 30-year. To Ramsey, the 30-year mortgage isn't a tool for affordability. It's a life sentence of interest payments. It's a product designed to keep you in debt and the bank rich. The 15-year loan, in his view, is the only path for people who are serious about building wealth. It's a forced savings plan on hyperspeed. Rule number 2, and this is the one that really hurts. The monthly payment, including principal, interest, taxes, and insurance, what the industry calls PITI, cannot exceed 25% of your monthly take-home pay. Not your gross pay before taxes, your actual after-tax in your bank account take-home pay. For Sarah and Tom, with their $7,500 a month, that number is $1,875. That is their absolute, non-negotiable ceiling. This 25% rule is the cornerstone of Ramsey's entire philosophy. It's designed to be a financial shock absorber. If one of them loses a job, if the car breaks down, if a medical emergency pops up, the house payment isn't an anchor that immediately drowns them. It leaves margin. It leaves breathing room in the budget to still live, save, and invest. It's a rule built for the worst-case scenario, not the best-case scenario. So Sarah and Tom go to the bank, armed with these two rigid rules: a 15-year fixed mortgage and a max payment of $1,875. They're also determined to put down at least 20% to avoid private mortgage insurance, or PMI, another Ramsey no-no. So they use their entire $45,000 savings for the down payment. After crunching the numbers with today's interest rates, property taxes, and insurance costs, the loan officer tells them the maximum home price they can afford. It's $210,000. Let that sink in. On a six-figure income in today's market, they can afford a $210,000 house. They are, to put it mildly, discouraged. This prices them out of the newer neighborhoods with the top-rated schools. It means a smaller home, maybe a longer commute, or a property that needs significant work. The dream feels diminished, compromised. Now let's turn to Mike and Jessica. They've heard of Dave Ramsey, but they find his advice unrealistic, out of touch. Their friends, their realtor, their loan officer, everyone is telling them the same thing. Nobody does a 15-year mortgage anymore. You can afford so much more house. And the bank is more than happy to show them just how much more. The bank doesn't care about your take-home pay. They use a metric called debt-to-income ratio, or DTI, and they base it on your gross monthly income. In this case, $10,000. Most conventional loans will allow your total monthly debt payments, including the new mortgage, to be as high as 43% of your gross income. Some FHA loans go up to 50% or more. Mike and Jessica have about $500 a month in car and student loan payments. So the bank runs the calculation. 43% of their $10,000 gross income is $4,300. Subtract their existing $500 in debt, and the bank says they can be approved for a monthly house payment of up to $3,800. That is more than double what Sarah and Tom were approved for under Ramsey's rules, on the exact same income. The bank also tells them they don't need a 20% down payment. They can get into a beautiful home with as little as 3 or 5% down. This sounds fantastic to Mike and Jessica. Why drain their entire savings account? They decide to put just 5% down, which is about $24,000, leaving them with a comfortable $21,000 cash cushion in the bank. And they opt for the standard, the default, the American way, a 30-year fixed-rate mortgage. With that higher payment and the 30-year term, the loan officer comes back with a smile. Great news, he says. You're approved for a home price of $475,000. $475,000. Compared to $210,000. This is the chasm that opens up between these two families. Mike and Jessica are ecstatic. They can afford the beautiful 4-bedroom house in the perfect school district. The one with the big backyard, the granite countertops, the 2-car garage. They sign the papers. Their monthly pity, including the PMI they now have to pay, comes out to around $3,750 a month. It's a huge number, representing half of their take-home pay. But the bank said it was okay, and they're in their dream home. Meanwhile, Sarah and Tom have to recalibrate. They have to hunt. They spend weeks looking at smaller, older homes. They finally find one for $205,000. It's a modest 3-bedroom ranch. The kitchen is dated, the yard is small, and it's a bit further from work. But it's solid, it's in a safe neighborhood, and it fits their numbers. They put 20% down, their entire $41,000, and take out a 15-year mortgage. Their all-in monthly payment is $1,850. So let's fast forward 1 year. Where are our two families? Mike and Jessica are loving their new life. They're hosting barbecues in their spacious backyard. Their kids are playing with the neighborhood children. They are house rich, but they are also cash poor. That $3,750 payment is a monster. It devours half of their income the day it hits the bank. After their other debts, groceries, and childcare, there is very little left over. That $21,000 cash cushion they kept is already dwindling after buying furniture and a new lawnmower. They're making it, but it's tight. There is no margin for error. They feel the pressure, the constant low-grade stress of being leveraged to the hilt. Across town, Sarah and Tom's life looks different. They sometimes feel a pang of envy when they see photos of their friends' bigger, newer homes on social media. Their house isn't a showpiece, but their finances are peaceful. Their $1,850 payment is less than a quarter of their take-home pay. It's almost an afterthought. After all their bills are paid, they have thousands of dollars left over each month. They are aggressively investing for retirement. They are saving for their kids' college. They are planning a real vacation, not just a weekend trip. They are in control. On the surface, Mike and Jessica appear to be winning. They have the bigger asset, the more impressive lifestyle. But what's happening underneath the surface is a seismic shift in their financial futures. One couple has chained themselves to a 360-month payment plan, a plan where in the first 10 years, the vast majority of their payment goes straight to the bank in interest. The other couple is on a 180-month sprint to freedom, building equity at a blistering pace with every single payment. They don't just own a house. They are actively and rapidly conquering it. This is the short-term reality. But the long-term consequences of this single decision are where the story truly gets terrifying and ultimately incredibly inspiring. The numbers don't lie. And what they reveal over the next 15 years will fundamentally change how you look at a mortgage forever. Let's meet two families. For our story, we'll call them the Ramseys and the Joneses. It's a bit on the nose, I know, but stick with me. Both families are nearly identical mirrors of each other. They live in the same town, they have 2 kids, they earn the exact same household income. A respectable $100,000 a year. And on the very same day, they both buy identical houses, right down the street from each other, for $400,000. Both families have worked incredibly hard, scrimped, and saved to put together an $80,000 down payment, exactly 20%, allowing them to avoid private mortgage insurance. From this moment on, their financial destinies, their stress levels, their ability to build wealth, and even the legacy they leave for their children will diverge so dramatically, it will seem like they're living in 2 different universes. And it all comes down to one single choice they make in the lender's office. The Joneses sit down with their loan officer, a friendly guy named Bob. Bob shows them the options. He points to the 30-year fixed-rate mortgage. At a hypothetical 6% interest rate on their $320,000 loan, the monthly principal and interest payment comes out to about $1,900. Bob smiles. "This is what most people do," he says. "It gives you breathing room. It's manageable, it's safe. You have flexibility." The Joneses look at each other and nod. Flexibility, breathing room. Those words sound wonderful. They think about car repairs, orthodontist bills, the occasional family vacation. That lower payment feels like a safety net. They sign on the dotted line for the 30-year mortgage, feeling smart and responsible. Next door, the Ramseys are meeting with their loan officer. They're presented with the exact same choice. The 30-year loan at $1,900 a month, or the 15-year fixed-rate mortgage. The loan officer punches the numbers. At the same 6% interest rate, the payment on the 15-year loan is just over $2,700 a month. That's $800 more a month. The Ramseys feel a knot in their stomachs. They look at their budget. It's going to be tight, really tight. No fancy vacations for a while. The car will have to last a few more years. Eating out will be a rare treat. Feels constricting, risky even, but they've committed to the plan. They take a deep breath, and with a slightly trembling hand, they sign for the 15-year mortgage. As they walk out of the office, the Joneses are already talking about where they'll go for dinner to celebrate. They have an extra $800 a month compared to their neighbors. Mr. Jones, who listens to a lot of finance podcasts, turns to his wife and says, "You know, we're going to be smart about this. We'll take that $800 difference every month and we'll invest it. We'll beat the mortgage rate in the stock market. By the end of 30 years, we'll have our house paid off and a massive nest egg. We're playing chess while they're playing checkers." Sounds brilliant. Sounds foolproof. It's the kind of logic that gets repeated all over the internet. Meanwhile, the Ramseys get home and immediately pull up their online banking. They set up the automatic payment for $2,700. It's a huge chunk of their income. It hurts to see it go. There's a flicker of doubt. Did they just make a huge mistake? Are they sacrificing their quality of life for nothing? This is the emotional reality of the choice. One family feels clever and liberated. The other feels constrained and anxious. Now let's fast forward just 1 month. The first mortgage payment is due. Mr. and Mrs. Jones see their $1,900 payment leave their account. They feel good. It's a comfortable payment. They have that extra $800 sitting there. They talk about investing it, but the water heater just started making a funny noise, and the kids need new shoes for school. "We'll start investing next month," they agree. No big deal. What they don't look at, what almost nobody ever looks at, is the amortization schedule. Of their $1,900 payment, do you know how much actually went to paying down their $320,000 loan? A measly $320. The other $1,600? Vanished. Poof. Gone forever. It was a payment made directly to the bank, pure profit, just for the privilege of borrowing their money for 1 month. They essentially rented their own money, and the rent was $1,600. Now let's check in on the Ramseys. Their massive $2,700 payment is withdrawn. It stings. They're eating rice and beans for the 3rd time this week. But let's look at their statement. Of their payment, the same $1,600 went to interest. That's the brutal math of a big loan. But $1,100 of their payment went directly to the principal. In the very first month, the Ramseys paid down their loan by more than 3 times what the Joneses did. They didn't just make a payment, they bought back a significant chunk of their own freedom. They threw a haymaker at their debt, while the Joneses were just shadowboxing. This is the hidden poison in the 30-year mortgage. It's front-loaded with interest. For the first several years, you are barely making a dent in what you actually owe. You are almost exclusively paying the bank for the right to owe them money. Your payment is mostly phantom. It creates the illusion of progress, but in reality, you're a hamster on a wheel, running furiously just to stay in the same place. The Joneses feel like they're making a $1,900 house payment, but they're really only making a $320 house payment and a $1,600 stupid tax payment to the bank. Let's jump ahead 5 years. The Joneses have had a good run. They got a small raise at work. They did manage to invest that $800 difference a few times, but life, as it always does, got in the way. A trip to Disney, a minor surgery for the dog, a new set of tires. Their invest the difference plan never really materialized in a disciplined way. Their lifestyle simply expanded to absorb the extra cash. They don't feel broke, but they don't feel like they're getting ahead either. After 60 payments totaling $115,000 out of their pocket, they've managed to pay off just $22,000 of their principal. $93,000 gone, fed to the interest monster. They still owe nearly $300,000 on their home. Now the Ramseys. The last 5 years have been tough. They've been focused. They've said no a lot. No to fancy dinners, no to new cars, no to the latest gadgets. It's been a grind, but let's look at their statement. They've made 60 payments, totaling $162,000. It's a lot more out of pocket, no question. But their loan balance is now down to $241,000. They've paid off nearly $79,000 of their principal. That's $79,000 in pure, unadulterated home equity they've built. Their sacrifice has been converted directly into wealth. They can feel the momentum. The finish line, which once seemed impossibly far away, is now visible. They are winning. The Joneses have more cash flow, but the Ramseys have more net worth. The Joneses have the illusion of safety in their low payment, but they are shackled to a debt that will follow them for another 25 years. The Ramseys have less monthly cash, but they are building a fortress of equity around their family at an astonishing rate. One family is servicing their debt, the other is attacking it. And this fundamental difference in strategy is about to be tested in a way neither of them could ever imagine. Because the economy, which had been humming along nicely for 5 years, was about to hit a wall. And when that wall hits, one family's breathing room will suddenly feel like a suffocating trap, while the other family's disciplined sacrifice will become their ultimate salvation. The year is 2028. The economic forecast, once a sky of endless blue, is now filled with gathering clouds. Pundits on TV who had spent years talking about growth and opportunity are now using words like correction, headwinds, and restructuring. For most people, it's just background noise, a reason to be a little more careful. But for our two families, the Jacksons and the Millers, the storm is about to make landfall directly over their neighborhood. The wall they hit was a company-wide layoff. The same tech firm that had been a symbol of stability for both husbands announced a 15% reduction in force. It was swift, impersonal, and devastating. Both men, in different departments but with similar roles and salaries, found themselves with a cardboard box of their personal effects and a severance package that felt insultingly small. The music had officially stopped. Let's go to the Jacksons' house first. The one with the 30-year mortgage and the comfortable, low monthly payment. The night the news hit, the silence in their home was deafening. Panic, cold and sharp, set in. They pulled up their bank accounts. Their emergency fund, which they'd always meant to build up, was about $3,000. They just used a big chunk of it for a down payment on a new SUV because, after all, their income was stable and the monthly payment was manageable. They started scribbling down their monthly expenses on a legal pad. The mortgage payment, the one that gave them so much breathing room, was there. But it wasn't alone. Below it was the $500 payment for that new SUV. Then the $300 payment for his wife's car. The combined $800 in student loan payments they were still chipping away at. The minimum payments on 2 credit cards that held the balance from their last vacation. Suddenly, that breathing room the mortgage afforded them was a cruel joke. It hadn't created freedom. It had created a vacuum. And human nature, especially in a culture of consumption, abhors a vacuum. They had filled every square inch of that financial space with other obligations. Their total monthly nut, even without discretionary spending, was staggering. The severance would cover maybe 2 months. After that, they were staring into an abyss. Then came the second wave of panic. They thought, okay, worst case scenario, we sell the house. They logged into their mortgage portal to check their balance. For 5 years, they had faithfully made every single payment. Over 60 payments. They'd paid the bank nearly $70,000. And when they looked at their principal balance, their hearts sank. They had paid down less than $15,000 of the actual loan. The other $55,000, the vast majority of their payments, had vanished into the ether of mortgage interest. They weren't building wealth. They were servicing debt. They were renting money from the bank, and the rent was brutally high. Making matters worse, the recent economic downturn had cooled the red-hot housing market. Home values in their neighborhood had dipped by about 5%. When they did the math, factoring in their tiny sliver of equity, the cooling market, and the 6% commission for a realtor, they realized the horrifying truth. If they sold the house, they would have to write a check at closing. They were trapped. The low payment that was supposed to be their safety net was the very thing that had enabled them to build a cage around themselves. Now let's drive 2 blocks over to the Miller's house. The one with the risky and suffocating 15-year mortgage. The news of the layoff was just as shocking. The fear was just as real. A loss of income is a crisis for any family. But as the initial shock wore off, the feeling in their house was different. It wasn't the cold, paralyzing panic of the Jacksons. It was a tense, focused energy. The feeling of a team that had drilled for this exact emergency. They sat down at the same kitchen table, but they pulled up a different set of numbers. First, their emergency fund. Because their mortgage payment had forced them into a disciplined lifestyle for 5 years, saving had become a habit. They had a fully funded emergency fund with 6 months of expenses saved in a high-yield savings account. 6 months, not 2. Next, they looked at their budget. The mortgage payment was there, big and imposing, but below it, there was almost nothing else. They had bought used cars with cash. They had paid off their student loans aggressively before even buying the house. They had no credit card debt. Their only major monthly obligation was the very house they were sitting in. Their financial life wasn't a complex web of payments. It was a simple, sturdy fortress with one big gate to defend. And they had 6 months of supplies inside the walls. Then, just to understand all their options, they logged into their mortgage portal. They too had been paying for 5 years. But their statement told a radically different story. On their 15-year loan, a huge portion of every single payment went directly to the principal. In 5 years, they had paid the bank roughly $110,000. But of that, they had obliterated over $75,000 of their actual loan balance. They had built an enormous amount of equity. Their home wasn't a liability trapping them. It was a massive asset. If the absolute worst-case scenario hit, they could sell the house, walk away with a massive 6-figure check, and comfortably rent for a year while they got back on their feet. They had options. They had power. They had peace. This is the absolute heart of Dave Ramsey's mortgage philosophy, and it's the part that gets lost in the simple math debate. His advice is not fundamentally about interest rates. It's about risk. It's about behavior. The financial world tells you that the 30-year mortgage is safer because the payment is lower. Ramsey argues this is a dangerous illusion, that lower payment acts as a sedative, encouraging you to live closer to the edge, to take on other debts, and to fill that breathing room with lifestyle. It maximizes the bank's profit and your risk. The 15-year mortgage, he argues, is like a personal trainer for your finances. It hurts. The payment is higher. It forces you to be disciplined, to say no, to live on less than you make. It feels riskier month to month. But what it's actually doing is building financial muscle. Every single payment is a forced savings plan, cramming equity into your home at a staggering rate. It forces you to get rid of other debts, because you simply don't have the cash flow for car payments and credit card bills. It builds a fortress around your family. So when the inevitable storms of life hit, a layoff, a medical emergency, an economic recession, your foundation is made of stone, not straw. The Jacksons' breathing room became a suffocating trap because they built their life on the assumption that the good times would last forever. The Millers' sacrifice became their salvation because they built their life on the assumption that they wouldn't. This is the Ramsey paradox. The loan that feels safer makes you fragile, and the loan that feels riskier makes you strong. He's not just looking at the best-case scenario on a spreadsheet. He's looking at the worst-case scenario in real life. He's not optimizing for the interest rate. He's optimizing for you to win, even when everything else is going wrong. And the most powerful tool for winning in his playbook isn't just about how much you pay, but how fast you pay it. Because the fastest path to building wealth is to eliminate your single largest expense. But what about the counter-argument? What about the brilliant investors who say you should take the 30-year loan and invest the difference? They claim that's the truly smart way to build wealth. It's a compelling idea, one that promises the best of both worlds. And it's an argument we need to put under a microscope. So let's do it. Let's put the invest the difference argument on trial. On one side, you have the mathematicians, the optimizers, the spreadsheet gurus. On the other, you have Dave Ramsey and his philosophy rooted in human behavior. The stage is a hypothetical American family buying a home. Let's call them the Millers. The Millers are buying a $400,000 home. They have a 20% down payment, which is $80,000, so they need to borrow $320,000. They go to the bank and get 2 quotes. For a 30-year fixed mortgage, the rate is 6.5%. For a 15-year fixed mortgage, the rate is a little better at 6%. This is pretty typical. Lenders offer lower rates on shorter loans because their risk is lower. Now let's run the numbers. The 30-year mortgage at 6.5% gives the Millers a monthly principal and interest payment of $2,022. The 15-year mortgage at 6% has a much higher payment, $2,700. The difference between these two payments is $678 per month. This is the magic number. This is the difference that the financial gurus say the Millers should invest every single month. So let's play out this scenario. The Millers choose the 30-year loan. They are incredibly disciplined. Every month for 30 years, they take that $678 and invest it in a good S&P 500 index fund. We'll be generous and assume a historical average return of 10% annually. For 360 consecutive months, they never miss a payment, they never pull the money out, they never get distracted. They are financial robots. At the end of 30 years, they make their final mortgage payment. Their house is paid off. And that investment account? It has grown to a staggering $1.53 million. That's incredible. They own their home free and clear, and they are millionaires from that one simple strategy. On paper, this looks like an absolute, undeniable win. The case is closed, right? Not so fast. Let's see what happens if the Millers follow Dave Ramsey's advice. They take the 15-year mortgage. Yes, that $2,700 payment is a gut punch. It's tight. They have to be intentional. They can't afford the fancy vacations or the brand new cars that their 30-year mortgage-holding friends might be enjoying. For 15 years, they live on a budget and they attack that mortgage. And then, after 180 payments, it's over. They're done. In just 15 years, they own their $400,000 house free and clear. But the story doesn't end there. For the next 15 years, while the other version of the Millers is still sending $2,022 to the bank every month, our Ramsey Millers are completely debt-free. So what do? They take the entire $2,700 payment they used to make on their mortgage and they invest it. Every month. For 15 years. Using that same 10% annual return, what do they have at the end of that 30-year timeline? Their investment account would be worth $1.12 million. So let's compare. The 30-year Invest the Difference Millers have a paid-off house and $1.53 million in investments. The 15-year Pay It Off Fast Millers have a paid-off house and $1.12 million in investments. The math says the 30-year strategy wins by over $400,000. So Dave Ramsey is wrong. The math proves it. But this is where Dave would lean into the microphone and say the most important thing you'll ever hear about personal finance. You are not a spreadsheet. You are a human being. The biggest problem with the Invest the Difference strategy has nothing to do with the math and everything to do with the person executing it. The entire plan hinges on one fragile heroic assumption, that you will have the discipline to invest that difference every single month for 30 years without fail. Think about your own life. Think about the last 10 years, let alone 30. Did a car break down? Did a kid need braces? Did you get laid off? Or face an unexpected medical bill? Or let's be honest, did you just want to go on a nice vacation? Or upgrade your phone? Or renovate the kitchen? Life happens. When that $678 is sitting in your checking account, it's not just investment money. It's fix the water heater money. It's fly home for a family emergency money. It's we deserve a break money. The discipline required to perfectly execute this strategy over 3 decades is monumental. And for the vast majority of people, it's completely unrealistic. The 15-year mortgage, however, doesn't rely on your discipline. It enforces it. The bank doesn't care if your kid needs braces. That $2,700 payment is due on the 1st of the month. It's a forced savings and investment plan, with your home equity as the investment vehicle. You're not hoping your future self makes the smart choice. You're making the choice for them right now and locking it in. This brings us to the second, and perhaps more powerful part of Dave's argument: risk. The 30-year mortgage keeps you in debt, and therefore in risk for twice as long. For 30 years, a bank owns your home. For 30 years, you have a massive payment that you must make or you lose the roof over your head. In the Ramsey scenario, that risk is gone in 15 years. Think about the freedom. Imagine being 45 years old with no house payment. How does that change your career choices? How does that change your ability to handle a job loss or a health crisis? While the 30-year mortgage holder is sweating through a recession in year 22, hoping their investments don't tank and they can still make their house payment, the 15-year mortgage holder has been debt-free for 7 years, weathering the storm from a position of incredible strength. That peace of mind, that sleep-at-night factor, has a value that you can't calculate on a spreadsheet. Dave Ramsey isn't just optimizing for the highest possible net worth on paper. He's optimizing for the highest probability of winning with money in the real, messy, unpredictable world. He knows that a paid-for house is a cornerstone of financial peace. When you are debt-free, your shovel gets a lot bigger. Investing $2,700 a month feels completely different when you have zero risk and total control over your income. The math of the 30-year plan is a beautiful theory. It's a perfect world scenario. But Dave's 15-year plan is a battle-tested strategy for an imperfect world, designed for imperfect people. It prioritizes behavioral success over theoretical returns. It trades the possibility of a slightly higher net worth for the certainty of being debt-free in half the time. It's a plan that acknowledges that emotion, discipline, and risk are more powerful drivers of financial outcomes than a compound interest calculator. The debate, then, isn't really about math. It's about philosophy. Do you trust a spreadsheet, or do you trust a plan built around human nature? But what if there's a third way? A hybrid approach that tries to capture the best of both worlds? Many people advocate for getting the 30-year mortgage for its flexibility, but then making extra payments to pay it off in 15. It sounds like a perfect compromise. But this strategy has its own set of hidden traps and psychological pitfalls that Dave Ramsey is quick to point out. The first pitfall isn't a number on a spreadsheet. It's a flaw in our own human wiring. Dave Ramsey's entire financial philosophy is built on one simple, brutal truth. Personal finance is 80% behavior. It's only 20% head knowledge. You can know the math, you can build the perfect spreadsheet, you can have the best intentions in the world. But life has a funny way of getting in the way of our best intentions. The strategy of getting a 30-year mortgage and paying it off like a 15-year mortgage is, in theory, brilliant. It's the financial equivalent of having your cake and eating it too. You get the low mandatory monthly payment which acts as a safety net. If you lose your job, face a medical emergency, or have a sudden massive expense, you can dial back your payments to the minimum and weather the storm. You have flexibility. You have control. But Ramsey argues that this very flexibility is a beautifully disguised trap. Because for the vast majority of people, that extra payment is the first thing to go when life happens. Think about it. You start off strong. For 6 months, you diligently send in that extra $400, $500, $600. You're watching the principal shrink. Feels incredible. Then the air conditioner breaks. It's a $4,000 repair. Well, you tell yourself, we'll just make the minimum payment this month to cover the AC. We'll get back on track next month. But next month, your kid needs braces. The month after that, you see an unbelievable deal on a family vacation you know the kids would love. And each time the logic is the same. We have the lower payment for a reason. Let's use that flexibility just this once. Slowly, just this once becomes a habit. The urgency fades. The lower required payment becomes the new normal. The safety net stops feeling like an emergency-only tool and starts feeling like extra disposable income. And that grand plan to pay off the house in 15 years, well, it's still the plan technically, just keeps getting pushed back. You're now 5 years into your 30-year loan, but you've only made about 18 months worth of extra payments. You're not on a 15-year track anymore. You're on a 26-year track, and you might not even realize it. Ramsey's argument is that good intentions are not a plan. Hope is not a strategy. He believes that when you give yourself an easy out, you will almost always take it. He would say that the 15-year mortgage isn't just a loan product, it's a commitment device. The higher payment is a feature, not a bug. It forces you to be disciplined. It holds your feet to the fire. You don't have the option to skip an extra payment because it's not extra. It's baked into the loan. You must make that payment. This forces you to build your entire budget, your entire financial life around the reality of that higher payment. It changes your behavior from the ground up. The 30-year option with the plan to pay more allows you to keep your old spending habits while telling yourself you're making a sacrifice. It's a psychological loophole that millions of people fall through. But let's push past the psychology for a moment. Let's assume you are the exception. You are a financial Spartan, a model of discipline and consistency. You will make that extra payment every single month, come hell or high water, for 180 months straight. You will never be tempted by a vacation, a new car, or a fancy dinner. Even in that perfect scenario, Ramsey argues you are still losing. And this is where the second, more insidious trap is revealed. The math. A 30-year mortgage will, in almost every single case, have a higher interest rate than a 15-year mortgage. Lenders see the 15-year loan as less risky. You're paying it back faster, and typically, only people with stable finances and good discipline even apply for them. That lower risk for the bank translates into a lower interest rate for you. The difference might not seem like much. Maybe it's 0.5%. Maybe it's 0.75%. On paper it looks tiny. But over the life of a loan, that tiny difference becomes a mountain of your money that you are needlessly giving to the bank. Let's run the numbers. Let's imagine a $400,000 mortgage. You go to the bank and they offer you two options. Option A is a 15-year fixed mortgage at a 6% interest rate. Option B is a 30-year fixed mortgage at a 6.75% interest rate. That's a pretty typical spread. With a 15-year loan at 6%, your monthly principal and interest payment is $3,375. If you make every payment for 15 years, you will pay a total of $207,575 in interest. Now let's look at the 30-year loan at 6.75%. Your minimum required payment is much lower, only $2,594. This is the safety net everyone talks about. But you're disciplined. You're going to pay it off in 15 years. To do that, you can't just pay the 15-year payment amount of $3,375. Because your interest rate is higher, you actually have to pay more to achieve the same 15-year payoff. You would need to pay approximately $3,540 every month. That's over $160 more per month than the actual 15-year mortgage payment. So you do it. You pay $3,540 every month for 180 months. You pay off your house in exactly 15 years. You've achieved your goal. But what was the cost? Over those 15 years, you will have paid a total of $237,135 in interest. Let's put those two numbers side by side. The disciplined person with the 15-year mortgage paid about $207,000 in interest. You, the equally disciplined person who chose the 30-year mortgage for its flexibility, paid over $237,000 in interest. That is a difference of $30,000. You paid an extra $30,000 for a safety net you never even used. You paid a $30,000 premium for the illusion of control. It's the price of a brand new car, a down payment on a rental property, or a significant boost to your retirement accounts. It's money you lit on fire for no reason other than choosing the safer option that was mathematically worse from day one. This is the core of Ramsey's mathematical argument. Why would you willingly sign up for a higher interest rate, guaranteeing you'll pay more money for the exact same house, on the off chance you might need to lower your payments? He sees it as paying a massive insurance premium for a policy you shouldn't need if you have a proper emergency fund in place, which is his baby step 3, a non-negotiable prerequisite to even thinking about buying a house. So when you combine the two arguments, the picture becomes brutally clear. The 30-year, pay it off in 15 strategy is a gamble on two fronts. First, you're betting against your own human nature, betting that you'll maintain perfect discipline for over a decade. The statistics and behavioral science say you probably won't. Second, even if you win that bet, you're still losing the mathematical game. You're guaranteed to pay thousands or even tens of thousands of dollars more in interest for the privilege. It's a game that is rigged against you from the start, designed to prey on your desire for safety while quietly draining your future wealth. For Dave, the choice is obvious. The 15-year mortgage forces discipline, saves you a fortune in interest, and gets you to the finish line of a paid-for house, the ultimate symbol of financial peace, in half the time. It aligns your behavior and the math in the same direction, creating a powerful momentum toward becoming debt-free. So Ramsey's case against the 30-pay-in-15 strategy is a powerful 1-2 punch of behavioral psychology and cold, hard math. Seems airtight, but what if the world isn't that simple? What if that flexibility you're paying a premium for isn't just an illusion? What if, in today's volatile economy, it's the most valuable insurance policy you can buy? Let's call this flexibility what it really is: an insurance policy against life. And the premium for this policy is the slightly higher interest rate on a 30-year loan. Dave Ramsey would call this a stupid tax. He'd say you're a fool for paying 1 extra cent of interest. But I'd argue that in the real world, a world where things go wrong, it's one of the smartest insurance policies you can buy. Let's run the numbers, but this time, let's add a dose of reality. Meet two identical couples. We'll call them Team Ramsey and Team Flex. Both couples earn the same income, have the same down payment, and are buying identical $400,000 houses. Team Ramsey follows the gospel. They stretch, they sacrifice, and they get the 15-year fixed-rate mortgage. Let's say their interest rate is a solid 6.5%. Their monthly principal and interest payment is about $3,475. It's a beast of a payment, but they're filled with that gazelle intensity. They're going to be debt-free in 15 years no matter what. Now meet Team Flex. They look at the same financial landscape and make a different choice. They opt for the 30-year fixed-rate mortgage. Because the term is longer, the bank charges a slightly higher rate, let's say 7%. Their monthly principal and interest payment is about $2,660. That's over $800 a month less than Team Ramsey's payment. It's a huge difference in monthly cash flow. Now here's the critical part. Team Flex isn't lazy or undisciplined. They're strategic. They look at that $800 difference and they make a plan. They decide to pay an extra $815 on their mortgage every single month. Their total monthly payment becomes $3,475, exactly the same as Team Ramsey's. By doing this, they're not going to take 30 years to pay off their loan. They're on track to pay it off in about 15 years and 3 months. For the sake of a few extra months and a bit more total interest, they've achieved almost the exact same outcome. So what's the point? Seems like they just ended up in the same place. But they didn't, because life isn't a spreadsheet. 1 year into their mortgages, a recession hits. The company that both husbands work for announces massive layoffs. Both are let go on the same day. Suddenly, that high income they relied on is gone. Both couples have followed Dave's advice and have a 3-month emergency fund. For Team Ramsey, their emergency fund is calculated to cover their massive $3,475 mortgage payment, plus other necessities. The clock is ticking and it is loud. Every month that goes by, a huge chunk of their safety net vanishes. The pressure is immense. They have to find a new job, not a good job, but any job right now just to stop the bleeding. After 3 months, their emergency fund is gone. The 4th mortgage payment is due, and they have nothing. They miss a payment, then another. The terrifying letters from the bank start arriving. Their credit score, which they work so hard to build, is in free fall. The dream of homeownership has become a waking nightmare of foreclosure. They did everything right, but the system was too rigid. It had no give. Now let's check in on Team Flex. The exact same catastrophe happens. The husband is laid off. The income is gone. They have the same 3-month emergency fund, but they have a secret weapon. The moment the layoff happens, they make one phone call. Not to the bank, not to a lender, but to each other. They decide to immediately stop paying the extra $815 on their mortgage. Their required monthly payment instantly drops back down to the $2,660. This single move changes everything. Their emergency fund, which was designed to last for 3 months, now stretches to nearly 5 months. The ticking clock slows down. The suffocating pressure eases. They have breathing room. They have time to be more selective in their job search, to find a position that truly fits, not just the first one that comes along. They aren't staring down the barrel of foreclosure. They are in control. The $800 a month they were overpaying wasn't just paying down their mortgage faster. It was an investment in a financial shock absorber. The slightly higher interest rate they paid wasn't a stupid tax. It was the premium on the best insurance policy they ever bought, the insurance of flexibility. A Ramsey follower might argue, they should have just had a 6-month emergency fund. And that's fair. But let's be realistic. For the average American family, saving 6 months of expenses, especially when you're also saddled with a monster 15-year mortgage payment, is an incredibly difficult task. And what if the job loss lasts 7 months? Or 9? There's always a scenario where the emergency fund isn't enough. The 30-year mortgage strategy provides a dynamic, adjustable safety net that a static pile of cash simply can't. But this is about more than just surviving disaster. It's also about capitalizing on opportunity. The core difference between the 15-year and 30-year mortgage isn't just risk, it's opportunity cost. Dave Ramsey's philosophy is built on the absolute elimination of debt, viewing it as a moral failing, a ball and chain to be sawed off at any cost. But this black and white view ignores a fundamental concept that wealthy people understand intimately: leverage. Not all debt is created equal. A 25% interest rate credit card is a financial cancer. A 7% car loan is a wealth-destroying leak in your budget. But a long-term fixed-rate mortgage, especially a rate secured below the historical average rate of inflation, isn't just debt. It's a tool. It's arguably the most powerful wealth-building tool available to the middle class. Think about it. You're using the bank's money to buy an asset that is likely to appreciate over time. While that's happening, another more silent force is working in your favor: inflation. Inflation is the secret superpower of the long-term debtor. Your mortgage payment is fixed. That $2,660 payment for Team Flex is locked in for 30 years. But what isn't fixed is the value of $1. Or your salary. In 10 years, due to inflation and hopefully career progression, your income will likely be significantly higher. The cost of groceries, gas, and everything else will be higher. But that mortgage payment? It's exactly the same. Feels smaller. In 20 years, it will feel even smaller. You are paying back a massive loan with future, less valuable inflated dollars. It's a financial cheat code. By choosing the 15-year mortgage, you are choosing to pay back the bank with today's very valuable, hard-earned dollars as quickly as possible. You are sacrificing the powerful, decades-long tailwind of inflation. You're essentially in a race to give the bank their money back before it has a chance to devalue. Team Flex, on the other hand, understands this. After the job crisis is over and they're back on their feet, they have a choice. They can go back to making the extra payments to pay off the house in 15 years. Or they can take that $800 a month difference and invest it. If they put that money into a simple S&P 500 index fund and get a conservative historical average return of 8 to 10%, the results are staggering. They are building a massive nest egg in a separate liquid account, all while their house is still appreciating and their loan is being eroded by inflation. They are building two pillars of wealth simultaneously. Team Ramsey is building one. This isn't about being in debt forever. It's about being strategic. It's about understanding that financial freedom isn't just about having a zero balance on your mortgage statement. It's about having options. It's about having the liquidity to weather storms and the capital to seize opportunities. The Ramsey plan offers you a single rigid path to one definition of freedom. The flexible approach, however, offers a dynamic strategy to build comprehensive, resilient wealth. Of course, this all hinges on one giant human-sized variable: discipline. The entire case for the 30-year mortgage as a strategic tool collapses if Team Flex takes that $800 difference and spends it on fancy dinners, new cars, and vacations. And isn't that the core of Dave Ramsey's argument? That most people lack the discipline to do the right thing, so you have to force their hand with a high payment? He's betting against human nature. Is he right? Are we trading a simple math problem for a much more complex behavioral one? And how does the ultimate mortgage hack, refinancing, completely change the game for both teams? Refinancing. It's the trump card, the get-out-of-jail-free card for the 30-year mortgage team. The argument is almost seductively simple. Why lock yourself into a high payment on a 15-year loan when you can get the best of both worlds? Take out a 30-year fixed-rate mortgage. You get the lower required payment, which acts as a massive safety net. If you lose your job, have a medical emergency, or the furnace explodes, you can easily make that smaller payment. But, and this is the key, you don't just pay the minimum. You act like you have a 15-year mortgage. You calculate what that higher payment would be, and you voluntarily pay that amount every single month. You get the psychological and financial security of a low minimum payment, but the rapid equity building and interest-saving power of a 15-year payoff schedule. You have flexibility. You have control. If rates drop, you can refinance. If life gets messy, you can scale back. On paper, it is the objectively superior mathematical and strategic choice. It seems unbeatable. So why does Dave Ramsey despise this strategy with the fire of 1,000 suns? Because he believes that for the vast majority of human beings, it's a complete fantasy. He's not making a mathematical argument. He's making a human one. He argues that paying extra on your mortgage is in the same category as, "I'll start my diet on Monday," or "I'll clean out the garage this weekend." It's a wonderful intention that gets trampled by the stampede of real life. The logic is brutal but hard to ignore. For the first few months, you're disciplined. You make that extra payment. You feel great. But then life happens. The kids need braces. The car transmission dies. A friend plans an amazing trip to Mexico, and you get a serious case of FOMO. That extra money you were sending to the mortgage company is just sitting there, accessible. It's not required. So you skip a month. Then another. Soon, that extra payment becomes the exception, not the rule. Before you know it, 5 years have passed, and you've been making the minimum 30-year payment the whole time, paying tens of thousands in interest you swore you would avoid. The 15-year mortgage, in Dave's world, is a forcing function. The high payment isn't a bug. It's the most important feature. It's an automated, legally binding discipline machine. It forces you to adjust your lifestyle. It forces you to prioritize the debt. You can't decide to skip the extra payment because there is no extra payment. It's all just the payment. You signed a contract that says you will be disciplined. You outsourced your willpower to the bank. Dave is betting that your good intentions will fail, so he wants you to build a system where they can't. And what about that refinancing trump card? Well, it's not as simple as waving a magic wand. First, refinancing isn't free. Not even close. You're essentially taking out a brand new loan to pay off your old one, which means you're going through the whole costly process again. You have to pay for a new appraisal, title search, origination fees, and a dozen other line items that can add up to 2 to 5% of your loan balance. On a $400,000 loan, that could be $8,000 to $20,000 in closing costs. That money is either paid out of pocket or, more commonly, rolled into the new loan, which means you're actually increasing your debt to save money on interest, a painful irony. Because of these high costs, you need more than just a small dip in interest rates to make it worthwhile. The general rule of thumb is that you need to be able to drop your rate by at least a full percentage point, maybe more, to overcome the closing costs and make the whole exercise worth the mountain of paperwork. This is where the popular 2022 and 2023 mantra of date the rate, marry the house starts to look a little shaky. The idea was simple: buy the house you love now, even at a high 7% interest rate, because you can just refinance in a year or two when rates inevitably come back down. It sounds great, but it's a massive gamble. It assumes that rates will drop, and that they'll drop significantly. What if they don't? What if they stay flat for 5 years? Or what if they only drop from 7% to 6.25%? After paying $10,000 in closing costs, your monthly savings would be minimal. You'd be stuck. The entire strategy hinges on the Federal Reserve acting in a way that benefits you personally, on a timeline that works for your budget. You are no longer in control. You are a passenger, hoping the market drives you to the right destination. The 15-year mortgage holder doesn't have this problem. Their plan doesn't rely on future market conditions. Their path to being debt-free is clear, predictable, and entirely within their control. They are the driver. It might be a bumpy, uncomfortable ride with a high payment, but the destination is guaranteed. In 180 payments they arrive. They are free. The 30-year borrower who is banking on a future refinance is standing on the side of the road with their thumb out, hoping the right car comes along. Now, Dave isn't universally against refinancing. He's a fan of what's called a rate and term refinance if it serves one purpose: to accelerate your debt freedom. If you have a 30-year mortgage and rates drop enough that you can refinance into a 15-year mortgage for a similar or even lower payment, he'd tell you to do it in a heartbeat. You're using the tool to get on the faster plan. What he considers a cardinal sin is the cash-out refinance. This is where you don't just get a new loan for what you owe. You borrow more money, taking out your home's equity in the form of a big check. People do this to consolidate debt or, more often, to fund a big home renovation. To Dave, this is financial poison. You are treating your house, the greatest wealth-building tool you have, like a personal ATM. You're undoing years of hard work, resetting the clock on your debt, and turning your appreciating asset back into a giant liability, all for a new kitchen or a finished basement. This brings us back to the core of the conflict. The 30-year plus extra payments plus refinance strategy is a game of optimization. It's for people who want to squeeze every last drop of mathematical efficiency out of their money. It requires discipline, market knowledge, and a little bit of luck with interest rates. Dave Ramsey's 15-year plan isn't a game of optimization. It's a game of elimination. Eliminate the debt. Eliminate the risk. Eliminate the temptation. Eliminate the need to watch the markets or guess what the Fed will do next. It's a brute force solution designed for maximum behavioral effectiveness, not maximum mathematical elegance. It's built on the belief that a good plan you actually stick with is infinitely better than a perfect plan you abandon when life gets complicated. So we have the math optimizers, armed with spreadsheets and rate watch alerts, playing a complex game with more risk but potentially higher rewards. And we have the behavioral realists, armed with a simple, powerful plan that trades flexibility for certainty. But we've left out the single biggest factor, the one variable that can blow this entire debate wide open: the stock market. What if you took that 30-year mortgage, made only the minimum payments, and invested the difference between that and a 15-year payment? We're no longer talking about just saving a few points on interest. We're talking about deploying that cash into the most powerful wealth creation engine in history. This is the ultimate argument against paying off your house early, and it's where the numbers get truly staggering. How does Dave's advice to be debt-free stack up against the raw, compounding power of the S&P 500? Let's put this to the test. A real-world, head-to-head battle. On one side, we have Team Ramsey, following the baby steps to the letter. On the other, Team Investor, who see their mortgage not as an emergency, but as an opportunity. Both teams are identical. They're the same age, have the same income, and they just bought the exact same house for $400,000. They both put 20% down, leaving them with a $320,000 mortgage on a 30-year fixed loan at 5% interest. Their monthly principal and interest payment is $1,718. And here's the key: both teams, through hard work and budgeting, have found an extra $1,000 every single month that they can deploy. The question is, where do they deploy it? Team Ramsey gets their marching orders straight from the master. Every single cent of that extra $1,000 goes directly onto the mortgage principal. Their mission is clear: kill the debt. They're not just paying $1,718 a month, they're paying $2,718. They are waging war. And the results are dramatic. Instead of taking 30 years to pay off their home, They obliterate that mortgage in just 11 and a half years. Think about that. Before they even hit their mid-40s, they own their home free and clear. The feeling is euphoric. They've saved over $190,000 in interest payments. They are completely, totally debt-free. They've won. Now, for the next 18 and a half years, the time remaining on that original 30-year loan, they take their entire old house payment, the full $2,718, and they start investing it like crazy into S&P 500 index funds. They are gazelle intense, just like Dave taught them. Fast forward to the end of that 30-year timeline. Their house, let's say it appreciated modestly and is now worth $800,000. And their investment portfolio? After 18 and a half years of aggressive contributions, it's grown to a staggering $1.6 million. Their total net worth at the 30-year mark, $2.4 million. A phenomenal success by any measure. They followed the plan and it worked. They are millionaires with a paid-for home and zero stress. But what about Team Investor? They heard Dave's plan, they understood it, but they chose a different path. They looked at their 5% mortgage, and then looked at the stock market's historical average return of 10%. They saw not a risk but an arbitrage opportunity. A 5% spread they could exploit for decades. So they decided to make only the minimum required payment on their mortgage for the full 30 years. That extra $1,000 a month? From day one, it went straight into the same S&P 500 index fund. They never paid a single extra penny on their mortgage. They let the 30-year loan run its full course. For the first 11 and a half years, they felt a little behind. They watched Team Ramsey celebrate their mortgage burning party, while they were still dutifully sending checks to the bank. They still had a massive debt hanging over their heads. But while Team Ramsey was aggressively paying down their house, Team Investor's small, consistent $1,000 investment was quietly beginning to compound. Then, for the next 18 and a half years, while Team Ramsey was investing $2,718 a month, Team Investor just kept doing what they'd always done, paying their mortgage and investing their $1,000. So, where do they stand at the end of the same 30-year period? Their house is now paid off too. It's worth the same $800,000. But what about their investment portfolio? They invested less per month than Team Ramsey did in their investing phase. But they invested for longer. Their $1,000 a month, invested consistently for 30 full years, didn't grow to $1.6 million. It grew to over $2.2 million. Their total net worth isn't $2.4 million. It's over $3 million. That's a $600,000 difference. $600,000. Just by making a different decision with the same amount of money. How is this possible? It's the single most powerful force in finance. Time and compound interest. Team Investor's money had 30 years to work for them. Team Ramsey's money only had 18 and a half. That first decade is where the magic of compounding is seeded. By diverting their capital to pay down a low-interest debt, Team Ramsey effectively sacrificed their investment's most powerful decade of growth. The math is brutal and unemotional. In a direct comparison, leveraging a low-interest, fixed-rate mortgage to invest in the stock market creates significantly more wealth over the long term than paying off the mortgage early. It's not even close. This is the opportunity cost that Dave's critics scream about. Every extra dollar you send to your 5% mortgage is a dollar that could have been earning 10% in the market. You are choosing a guaranteed 5% return, the interest you save, over a potential and historically probable 10% return. On paper, it's a losing trade every single time. So, case closed, right? Dave Ramsey is wrong, the math proves it, and everyone should keep their mortgage for 30 years and invest the difference. Well, this is where the spreadsheet ends and real life begins. Because that $600,000 difference comes with a massive invisible asterisk attached. It assumes one critical thing. That you are a perfect, rational, emotionless robot who will execute the plan flawlessly for 30 years. And that is the one variable that can bring the entire mathematical argument crashing down. The numbers we just ran exist in a vacuum. They don't account for fear. They don't account for panic. And they don't account for human behavior. Team Investor had to endure every single market crash for 30 years. They had to watch their portfolio get cut in half in 2008 and keep investing. They had to stomach the COVID flash crash and not sell. They had to have the discipline every single month for 360 months to invest that $1,000 and not spend it on a vacation, a car, or a home renovation. That is a monumental feat of psychological endurance. Team Ramsey, on the other hand, had a much simpler, behaviorally aligned goal. Their enemy was tangible. The mortgage balance. Every extra payment made that number go down. They saw progress every month. It was a guaranteed risk-free win. And once the house was paid off, the sheer momentum and relief from that victory created an incredible psychological tailwind. Suddenly, investing over $2,000 a month felt easy, because for over a decade, that money was already gone from their budget. They were used to not having it. This is the core of the debate. It's not about math. The math is settled. It's about behavior. The mathematically superior strategy is also the behaviorally most difficult. The mathematically inferior strategy is the one that is far easier for the average person to actually follow through on. It provides emotional and psychological security, the paid-for house, that can't be quantified on a spreadsheet. That feeling of security might be the very thing that prevents someone from making a catastrophic mistake, like panic selling their entire portfolio at the bottom of a market crash. A mistake like that wouldn't just erase the $600,000 advantage, it could wipe out their entire financial future. Dave Ramsey didn't build a financial empire by being bad at math. He built it by understanding that personal finance is only 20% head knowledge and 80% behavior. He knows that for most people, the biggest risk isn't the stock market's volatility. It's their own reflection in the mirror. His plan is a system designed to protect you from yourself. So the question becomes, which is more important? The plan that looks best on paper, or the plan you're most likely to stick with? The numbers paint a clear picture, favoring the investor. But what if the mathematically suboptimal decision is actually the right one for a majority of people? And more importantly, is there a third path? A hybrid approach that could potentially give us the best of both worlds? This third path, this hybrid approach, is where the debate gets truly interesting. It's the attempt to have your cake and eat it too. The strategy is simple. You take out a 30-year fixed-rate mortgage, but you make extra payments every month as if you had a 15-year loan. You use an online amortization calculator, figure out what the 15-year payment would be, and you commit to paying that amount. On the surface, this sounds like the perfect solution. You get the wealth-building speed of the 15-year plan, methodically chipping away at your principal and saving tens, if not hundreds of thousands of dollars in interest. But you also retain the safety net of the 30-year mortgage. If life throws you a curveball, a job loss, a medical emergency, a sudden need to replace your roof, you're not locked into that high 15-year payment. You have the legal right to drop back to your lower, contractually obligated 30-year minimum payment, freeing up hundreds of dollars in cash flow precisely when you need it most. It's financial flexibility. It's an emergency brake built directly into your biggest liability. So why doesn't everyone just do this? If it offers the best of both worlds, why is it even a debate? There are two critical reasons. The first is pure math. The interest rate on a 30-year mortgage is almost always higher than the rate on a 15-year mortgage. Lenders charge more for the longer-term risk. So, even if you pay it off in 15 years, you will have paid a slightly higher interest rate for that entire time. You're essentially paying a premium for the flexibility for that emergency brake. Over 15 years, this can add up to thousands of dollars in extra interest compared to someone who just got the 15-year loan from the start. But the second reason is far more important, and it brings us right back to the core of Dave Ramsey's philosophy. It's one word: discipline. The hybrid approach requires unwavering, long-term robotic discipline. For 180 consecutive months, you have to voluntarily pay more than you are legally required to. There's no accountability partner, no bank forcing your hand. Every single month, you will see that lower minimum payment on your statement, a siren song whispering, "Hey, you could pay less this month. Think of what you could do with that extra $800. A vacation, a new TV, dinners out." The greatest strength of the hybrid plan, its flexibility, is also its greatest weakness. It relies entirely on your future self being just as motivated and disciplined as your present self. And as we all know, life has a way of eroding our best intentions. For the person who is a spreadsheet wizard, who automates their finances and has the willpower of a Shaolin monk, this strategy can be brilliant. But Dave Ramsey isn't talking to that person. He's talking to the masses. He's talking to the person who has struggled with credit card debt, the person who buys things they don't need, the person for whom temptation is a real tangible force. For that person, the 15-year mortgage isn't just a loan product. It's a commitment device. It's what behavioral economists call a Ulysses pact. In the ancient Greek epic, Ulysses wants to hear the song of the sirens, which drives sailors to their death. So he has his crew tie him to the mast of the ship and plug their own ears with wax. He makes it impossible for his future self to give in to temptation. The 15-year mortgage is tying yourself to the mast. You are forcing your future self to make the financially prudent choice by taking the option of a lower payment completely off the table. You are removing the single greatest point of failure, your own wavering discipline. And this reveals the fundamental truth of the entire debate. We've been framing this as math versus behavior, but it's really about something deeper. It's about offense versus defense. The mathematical argument for the 30-year mortgage is a purely offensive strategy. It's about maximizing every dollar to generate the highest possible return over a lifetime. It's about leverage, arbitrage, and opportunity cost. It views your home equity as lazy money that needs to be put to work in the market. It is a strategy focused on building the biggest possible net worth on a spreadsheet. Dave Ramsey's 15-year, paid-off early plan is a purely defensive strategy. It's not about maximizing potential returns. It's about eliminating potential threats. It's about mitigating risk, building a fortress, and making your financial life as simple and invulnerable as possible. It views debt not as a tool, but as an enemy that must be vanquished. Its goal isn't the biggest possible net worth. It's the highest possible probability of never, ever going broke. It's about the peace of mind that comes from knowing that no matter what happens, you lose your job, the market crashes, a pandemic hits, you will always have a roof over your head. You cannot put a rate of return on that feeling. There is no spreadsheet column for the sleep at night factor. How much is it worth to you to be able to quit a job you hate without a new one lined up? How much is it worth to you to start your own business, knowing your family's housing is secure? How much is it worth to you to face a recession not with fear, but with a sense of calm because your single biggest expense has been permanently eliminated from your life? The financial optimizers will call this an emotional decision, and they are absolutely right. But our lives are a series of emotional decisions. We don't choose our partners based on a spreadsheet. We don't choose our careers based on a discounted cash flow analysis. To ignore the profound psychological impact of money is to ignore half of the equation. So, who is right? The answer is they both are. The question isn't which advice is better. The question is, which advice is better for you? Dave Ramsey's advice is brilliantly tailored for its intended audience. People who are overwhelmed by debt, who lack financial discipline, and who crave simplicity and security above all else. For millions of Americans, his simple black and white rules have been a lifeline that pulled them out of financial chaos. The mathematical suboptimization is a small price to pay for a plan they can actually stick with. The 30-year mortgage and invest the different strategy is for a different person. It's for the high-income earner with a stable job, a fully funded emergency fund, automated investments, and a high tolerance for market risk. It's for the person who understands and is comfortable with leverage, who has the discipline to see the plan through for 3 decades, and who is willing to trade a little bit of security for a lot more potential wealth. In the end, this isn't about interest rates or investment returns. It's about self-awareness. It's about looking in the mirror and asking yourself some honest questions. Are you the kind of person who needs to be tied to the mast? Or are you the kind of person who can captain the ship through the storm? Is your primary financial goal to win the game by the biggest margin? Or is it just to make absolutely sure you never lose? What does financial freedom mean to you? Is it a number on a screen, representing a massive investment portfolio? Or is it the feeling of turning the key in the door of a house that you own free and clear, with no one to answer to but yourself? There is no single right answer. Dave Ramsey's plan will reliably get you to the 80-yard line, safely and securely. The Leverage and Invest plan offers the potential to get you into the end zone and maybe even win the Super Bowl, but it also comes with a higher risk of a career-ending injury along the way. The best plan is not the one that looks best in a spreadsheet. It's the one that aligns with your personality, your goals, and your tolerance for risk. It's the one that you can commit to day in and day out for the long haul. Because the most sophisticated financial strategy in the world is worthless if you can't stick with it when life gets messy. And the most important investment you can ever make is in a plan that lets you sleep peacefully at night. Choose that and you can't go wrong.